Hello and welcome to Portfolio Matters, weekly markets checklist, week 193. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we'll be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Okay, so this week, because it's only a week since the last one, we're going to try and rush through the markets and economic data to get through a lot of special sections which have been queuing up. So this week, Trump and Putin met in Alaska. Not much happened. Trump had said beforehand if there was no ceasefire, there'd be severe consequences for Putin. There weren't any. Trump is now attempting to arrange a meeting between Zelensky and Putin, but markets are pricing in a low probability of a ceasefire. Having fired the head of the BLS when non-farm payrolls data didn't come in as he would have liked, Trump has now appointed the conservative blogger E.J. Anthony, who is a big Trump supporter, as the new head of the BLS. He's been photographed at the 6th of January riot attempting to storm the Capitol building. The fundamental problem is that no serious statistician is going to accept a position where they may be fired if they report data that Trump doesn't like. Now, I've read that actually the head of the BLS has very little influence on the data. Let's hope that's true, because Trump is attempting essentially to undermine the independence of all the institutions in the US. On that note, US Treasury Secretary Scott Bessent has told a TV audience that Fed's funds rate should be 150 to 175 basis points lower than it is, putting further pressure on Jay Powell to cut rates. The Trump administration clarified that gold imports are not subject to tariffs. Bond yields rose this week, nastily. In economic news, US inflation came in on target at 2.7%, unchanged from June in July, but core rose to 3.1%. There's definite signs that goods inflation is rising due to tariffs. As manufacturers run down the inventories they bought pre-tariff, how much will goods prices rise further as they start to pass on more of the tariff price rises? We've got some charts for you. UK GDP came in slightly better than expected at 0.3% in Q2, still pretty anemic. And the bad news was productivity fell by a shocking minus 0.6% in the quarter. Chinese industrial production and retail sales came in weak. In fact, all the Chinese data this week came in weak. S&P 500 continued to rise, hitting a new high, and UK bond yields also had a terrible week, hitting a new post-pandemic high. We'll show you the data in due course. Some charts relating to the news. Well, Scott Bessent is saying Fed funds should be 175 basis points lower. Well, normally when you have inflation above target, you have restrictive monetary policy. And he's talking about having loose monetary policy when inflation is ticking up again. The table.
Can I just chip in something? So Scott Bessent, I think, is a very bright guy.
Yeah.
And I think he knows where he wants to take the US economy. Now, whether he's right or not, I'm not offering a view, but I think he knows where he wants to go with it. And I think he realizes he can't go with it if he's not a buddy of Trump.
Mm.
And so sometimes I think he will say things that he doesn't necessarily mean.
Yeah, no, I agree with that.
And that is the Trump mantra that interest rates should drop. I don't know that Scott Bessent necessarily believes it. He may do, he may not, but I think he has got a very clear idea of his long game.
Yes, but essentially everyone's short-term interest is to suck up to Trump.
Yeah.
And so he's undermining all the institutions of the US because everyone is kowtowing to him rather than standing up for, the institutions that have made America the economic juggernaut it is.
Yeah.
So this is the Taylor rule. It says the actual Fed funds rate should be even higher than it is. Well, higher than it is. It's not that terribly high. This is the odds of a ceasefire in Ukraine. They've risen a bit, but nobody's actually expecting one. Scott Besson will be pleased. The market expectation of the Fed funds rate is for a further 5 cuts over the course of the next 18 months. Now, I thought this was interesting. Trade flows between China and the US are falling, as you might expect. They had a bit of a bounce. We thought trade was coming back. Since then, they've fallen quite sharply. The US national debt blasted through 37 trillion and is going higher rapidly. Out of control. The market is pricing in an 83% chance of a rate cut in September, like next month, coming up soon. And the US is setting up a strategic Bitcoin reserve, though crucially, they're not actually buying Bitcoin, I believe. And the best performing currency against the dollar this year is the Russian ruble. Trump's mate Putin will be pleased. I'm not sure the Ukrainians will. And on to equities, Richard.
Thanks, Keith. So over the last week, looking at this, the only really significant change was the Russell 2000, about 3.5% in the week.
Yes. Yeah,
which is
absolutely.
a significant move. And as we recall, it's lagged the year to date, and it's now 3% up for the year to date. So the FTSE All World's up 13% year to date. All share 11%, Stocks Europe 10%, and S&P 500 9.5% year to date. Nasdaq up 12%, Hang Seng up of that very healthy 25%. The Topix up 12%, Bitcoin not a very good week, down 3%, but still up 24% for the year. The pound up nearly 8% year to date. The euro up 12.5% year to date. The dollar index down 10%, and the VIX down 8% last week and 14% nearly year to date.
Yeah. Markets not worried about anything, basically, just grinding higher.
Yeah. FTSE All World Equity Index, FTSE All Share, Euro Stoxx 600, S&P 500, Nasdaq Composite, Russell 2000.
Good week for the Russell 2000.
Yeah, very good. Hang Seng, the Topix.
Topix is having a good run.
Yeah.
Strange.
It's Bitcoin, pound against the dollar, euro against the dollar index, and the VIX back down to its low lows. So the S&P 500 is at an all-time high, having gone up 34% since the April lows. Retail activity is around about 20% of the overall market, which is on the high side.
Yeah. Retail is very active.
Yeah, and it's increased at highest level since 2018.
Yeah, bit of irrational exuberance.
Yeah, so US REITs as a percentage of ETF market share down at about 0.6%, which is the lowest they've been since this chart began 20 years ago.
Yeah, essentially everyone's long tech and has cut everything else.
And by market cap, the US market represents 64% of total world equities.
Yeah.
Up from 30% 40 years ago.
Yeah. So the US seems to have captured the future by, it's all these big tech companies.
It has, hasn't it? Price to book ratio of S&P 500 is higher than the dot-com peak. And the market is expensive if you look at S&P 500 price to peak earnings ratio.
Yeah. So it's not earnings driving this market forward. It's just PE expansion,
Yeah.
valuations.
Price to sales ratio, 3.2 times.
That is pretty shocking, actually.
Yeah. The US semiconductors market cap weighting is now nearly 12%, up from 3% 10 years ago.
Yeah.
The return of capital employed of the Mag 7 is expected to decline. Will it decline or will it level off?
Well, the thing is, what they're doing is they're investing loads in capex. So therefore, unless their earnings rises commensurately, the return on capital employed is going to come down.
Yeah, that's true. So free cash flow yield is at just 2% for the big 7 tech companies because they're spending so much on capex.
Yeah, and it's collapsing, but the valuations keep rising.
Yeah. So the future S&P returns should be weak.
Yeah.
Based on historical valuations.
Well, based on the where the PE ratio is,
Yeah,
and future 10-year future returns. Frankly, I think the fit on this chart is just a bit suspiciously good. But we've been here before. Anyway, the market's doing based on valuation, future returns over the next 10 years should be weak. But right now, it keeps on climbing.
90% of fund managers think the market is overvalued, but still it keeps rising. Of course, 22% of retail investors don't, or the 22% of retail investors doing a lot of buying don't.
Well, we've got more on that later, frankly.
Assets in leveraged equity exchange traded products, 120 billion. And that is in comparison to, let us say, 10 years ago, 20 billion, 6 times as much.
Yeah. And for the absence of doubt, those products are really dangerous and systematically lose money. We've done a special podcast on this before.
Basically, if the share price doesn't change, you lose money every day.
Yeah.
Hedge funds have the share prices of the underlying assets. Hedge funds, big short position in small cap. They must have got a bit stuffed by the 5% rise in the Russell.
Yeah.
2000.
That's a very good point, Richard. But these big concentrated positions tend to unwind quite quickly.
Yeah. So if the current NASDAQ Mag 7 bubble, in inverted commas, follows the path of the .com bubble, then it's got another 50% from where we are now, another 20% from where we are now.
Yeah, absolutely.
And then, of course, all hell breaks loose.
Yes, well, I find these kind of historic comparisons very dodgy, but we thought we'd put this out there anyway.
So I glanced at an article, I don't think I read it, yesterday, where Sam Altman said he thought AI was a bubble. Although he's trying to raise money at a ridiculous valuation of 500 billion for OpenAI.
Well, we've got a big section on ChatGPT 5 coming up.
Not everybody is a fan, as far as I can tell.
Well, the performance, spoiler alert, performance is less good than advertised and within the range of existing models. But they've spent a hell of a lot of money on it.
So if you don't want to hear about that, if you don't want to, it's too late. So CoreWeave, which runs AI data centers, losses were higher than anticipated Q2, and insiders dumped $1 billion worth of stock
on the first day they could, 6 months after the IPO. I mean, it's testament to the depth of the US market, actually.
Yeah, that they can take it.
They can take it.
Yeah. It's all those the private investors. No, seriously, I suspect it is the private investors who are propping this market up to an extent. USification of Japanese stocks. Okay, so basically we've got a lot of share buybacks, dividends are flat, but total shareholder return is increasing, and share buybacks are presumably helping the market because the Japanese market is doing very well.
It is, yeah. No, this is a big turnaround. They've found shareholder capitalism. Amazing.
Tesla has a market cap of 1 trillion.
Yeah. Shocking.
It has declining revenues, declining profits, declining earnings, rising expenses. But notwithstanding all of that, the shares are up 48% over the past 12 months. And UK car sales year to date, Tesla pretty flat, really.
Yeah.
BYD zooming up.
Yeah. This is prompted by the fact I saw my first BYD the other day.
Would you buy a BYD, Keith? Do you want the Chinese government to know everywhere you drive?
I don't think my visit to Tesco's going to be terrible relevance to anyone. I don't care. Yeah, I'd happily buy a BYD, frankly. And on to commodities. So quick summary, energy generally a bit weak. Industrial metals largely flat over essentially what's just been a week, but lithium and neodymium continue to soar, actually. Precious metals weakish except for rhodium, which had a strong week. So on to energy. So Brent down just under 1%, WTI best part of 2%. Natural gas futures in Europe and the UK continue to come off. That's all great news, although of course it is summer, so you'd expect that. Coal drifting off a bit, uranium having a bit of bounce, flat on the year now. This is Brent down to 66, WTI down to 63. Both actually not at their lows for the year, surprisingly, despite OPEC opening the taps. Numbers specific to the oil market, well, inventories continued to build in the US, so the US was oversupplied by about 1 million barrels a day over the past week. Crude oil production has stabilized, but is still down 250,000 barrels a day since the start of the year. The Baker Hughes rig count actually ticked up by 1, but is still down 70 on the year. The EIA is forecasting that Brent will go down to 50 next year, and speculators would seem to agree. It's the first ever recorded net short position in WTI. So speculators are betting that oil prices will keep falling. Meanwhile, oil rigs in the Permian are ticking down. So next year, you'll see US oil production come down a bit. This is EU natural gas futures, lows for the year. It is summer. UK, the same, still good news. US natural gas also coming down. Coal up from its lows, seems to have stabilized. Uranium, is the bull market back on?
Yes. So I think, seriously, Keith, I think with uranium,
Yeah.
the bull market is back on, but one of the big drivers is AI and the energy of the data consumption of data centers.
Yes.
And that, I think, is not as such a given as some people think it might be.
Well, I've seen that 3 small US nuclear companies have raised money to build modular nuclear reactors. So we'll
Yeah,
see.
we will. I think it's very interesting. And yeah, as someone recently pointed out, modular nuclear reactors have been around for 50 years or whatever, because that's what powers a nuclear submarine.
Yes, of course. Yeah.
So technology, in some sense, is not particularly new. I guess it's commercialization of it.
Yeah, the thing is that actually when you look into the physics of nuclear reactors, it's more efficient, like energetically, to build them bigger.
Yeah.
The thing is that they, in building in the UK costs so much that if you can turn it into a process, you could save vast amounts of money.
I mean, the ideal is to be able to stick it into a couple of containers, isn't it? You can just ship it out, plug them together, and leave it for 20 years, and then replace the containers with new ones when it needs recharging.
Yeah.
So on to industrial metals. Pretty quiet week, actually, apart from, as Keith mentioned earlier, lithium, which is up 8.5%, neodymium up 12%. So we know that CATL or cattle anyway, the Chinese lithium miners basically shut down production on the instruction of the Chinese government because they was flooding, the market was being flooded and no one was producing material profitably. And I think there's been a bit of a volte face with the Chinese, which says there was no point in producing this stuff and dumping it on the world and China making a loss on the processing. So they have, it appears, decided to capitalize on their production and reduce production to create more of a shortage situation. I don't know if that's why neodymium has done that, gone up 12%, 48% year to date.
Well, funny things going on in rare earths at the moment.
Yeah, definitely.
Trade war related, I'd suggest.
So there's aluminium. And the Chinese are doing their best to control rare earth exports, aren't they?
Yeah.
Cobalt, copper, iron ore, lithium.
Wow.
Gone up 35% since July. Neodymium. You can't really buy neodymium, can you? Nickel. Tin. Zinc. And precious metals. So a very quiet week, as Keith said, apart from rhodium, pretty much unchanged. Palladium was down 3%. So rhodium up 7% on the week, 66% on the year.
Yes, yeah, very good.
So there's gold, which I think is going to break out of that wedge pattern upwards. And it has, relative to long treasuries since 2020, it has outperformed about 3 times as well. Well, not 3 times as well, it's 3 times as valuable.
Yeah.
Obviously, central banks have been switching away from US treasuries because they don't want to have their foreign assets frozen by the US or confiscated by the US and the EU, which signifies a breakdown in trust in the global order, which is probably not a good thing. So the historic inverse relationship gold prices and treasury yields has reversed, as it has at various times in the past.
Yeah.
And it appears to not really care what real yields are. It has other drivers. The drivers, it now has a much more significant than interest rates. So the gold to silver ratio, I'm very dubious about the people who say, because the gold to silver ratio is high, like currently something like 90, I think, and the historic average is around about 16. Therefore, the silver price needs to go up and will go up by 4-fold because it's going to revert to the mean. I mean, if you look at any other commodity, they don't behave that way. They're based on supply and demand, and I think silver's the same. So I don't buy that. I think silver is going to go up, but not because of the gold silver ratio. I think that's complete red herring.
Yeah, I
agree. It irritates me when people talk about it.
I just thought it was amusing, Richard.
Yeah, it is. I mean, it's completely, Keith. It's a very interesting little chart or little pictographic. So we have price of silver, 31% year to date. Platinum, nearly 50% year to date, and that's after its fallback over the last month or so. Rhodium.
Yeah, rhodium not dead,
Catalytic converters, I guess. Palladium, it's dead. Catalytic converters, I guess. Who knows?
And on to rates. So it's been an absolutely shocking 5 days for the UK. New highs for the 30-year. And frankly, my move into bonds has been a total catastrophe. Equities have done so much better. But, if the UK, but what's happening at the moment, I think, is that UK inflation is resurgent. And previously, the Bank of England was talking about inflation peaking in Q3 at 3.7%. It's now raised that to 4%. We have UK inflation numbers out tomorrow. I think the market's worried, frankly, and I don't blame it. When you look at the US, then yields across the curve are down from a month ago. If you look at the UK, they're up. This is a UK specific move in the yield curve. Not good. But interest rates should keep falling over the next year and a half globally. I mean, UK really needs to get inflation under control. I mean, when you look at UK base rates, 4%, and we have inflation that's higher than in the US, like 1% higher than in the US, and US base rates are higher. It's just, the UK has cut rates too hard, in my opinion. I thought this is an interesting chart. Italy has run a budget deficit for each of the last 100 years. And this week, Italian bond yields fell below French ones.
Why?
Because people are worried about France, basically. I'll take you through the chart in a second. So the Italian finances and growth seem better than France. Corporate bonds seem, the yield you get as a pickup over government bonds is at a 27-year low, which would suggest that markets are either very complacent about corporate debts, or they think that corporate debts are overvalued and government bonds undervalued. Take your pick. This is the UK 2-year market is worried. It's now pricing basically no more rate cuts. 10-year rising again back towards its highs. 30-year at new highs. Shocking. Really terrible. This is the US 10-year. You see well down from its highs. US has inflation better under control than UK. German 10-year actually rising. Not great. French, same. Italian, you see, not rising anywhere near as much. Markets are less concerned about Italy than they are France, Greece. And on to this week's economic data. On to the UK. Richard.
Thanks, Keith. So UK GDP quarter on quarter, 0.3%, better than expected. Year on year, a measly 1.2%.
Better than expected, though.
Yeah. But given the latest productivity data, how long is it going to last? Business investment quarter on quarter down 4%, pretty dreadful. And business investment year on year, 0.1%. I mean, we have a real investment problem in this country.
Yeah.
And UK labour productivity down 0.6% in the second quarter, and even much lower than expectations, but
yeah, not great.
No.
Yeah, this chart which accompanies it, I just don't see how that can be right. So that's the index. I don't see how it can have risen during the quarter when the headline numbers.
It can't, can it?
Yeah.
I agree, Keith. Unless it's like 3 months backdated or something.
Yeah.
UK construction orders year on year down 12%, which is in line with expectations, but not good. I mean, basically, UK construction appears to be falling fairly consistently over the last couple of years. Industrial production month on month actually up in July 0.7%, and year on year up 0.2%.
Yeah, i.e. within the kind of measurement error of 0. Yes,
exactly. The economic surprise index, for what it's worth, is a bit on the low side. Indeed, job postings index seems to have levelled off actually over the last month or two. UK wage growth is up a bit this month, up 6%.
Frankly, I thought this was an absolutely shocking and depressing number. Absolutely terrible, because in order to get inflation under control, you need wage growth to be under control. And that should be, in order to be compatible with the 2% target, you need wage growth. Actually, given we have a productivity problem,
precisely, yeah,
it's close to 2%.
Yeah, it's
even lower.
Yeah,
yeah, and it's going in the wrong direction. This is just a shocking number.
Yeah. And post-Brexit UK GDP growth has been anemic, and so there was that big drop, wasn't there? The discontinuity, if you like, of the line with the GFC 2008. and then the discontinuity, the COVID discontinuity, I think we've got, and then it has never really picked up, certainly since COVID. And the whole thing is just looking more and more sick. And actually, unless we have a government that comes in and really, really understands how to get productivity up, this country is going to continue to struggle to support itself.
Yeah, I agree.
And Rachel Reeves doesn't really get it. A few weeks ago, we showed this chart. Institute Director members are most pessimistic they have ever been about the prospects of the economy over the coming year.
Yeah, not good.
They're only mildly pessimistic about the prospects of their own company. That's like most drivers think they're above average.
Yes, exactly. So, I thought this is very interesting. Thanks for Jaded Persimmon to sending us this, a Discord member. But so, fallacy of composition, everyone's company can't be doing, not that bad, but the whole economy doing shit.
We're all just depressed, Keith. That's the problem.
Yeah,
the average family in England spent 36% of their income on rent in 2024, nearly 42% in London.
I mean, that is shocking. That isn't. I mean, I was blown at 42%. How can you live in this town?
But of course, this is why wages are going up, isn't it?
Yeah.
So there's a summary. I mean, if you want to be depressed, read it. If you don't want to be depressed, move on.
We'll move on. On to the EU, right? Very little data this week. We had the second estimate of GDP growth, and that was pretty much unchanged. 0.1% quarter on quarter, 1.4% year on year, i.e. not much. Employment growth, very similar. 0.1%, 1.4% year on year. Industrial production in June, down 1.3%, up 0.2% year on year. Not great. And the pre-tariff boom is now over. So the EU is now going to have to live with 15% tariffs on exports to the US. Let's see how industrial production does in the coming months. Economic Surprise Index, Europe continues to outperform, if we believe it. Indeed, job postings, labour market deteriorating. Wage growth, sticky. France, labour market deteriorating. Wage growth actually perfectly compatible with the 2% target. EU summary, not much data. Stagnation, basically. Inflation, 2%. GDP growth, 1.4. Not great. On to the US, Richard.
Thank you. So CPI month on month, 0.2%, and year on year, 2.7%. Core CPI month on month, 0.3%, and year on year, 3%. And one big, beautiful inflation chart is basically services prices are still high, and inflation is still around about 3%.
Yeah, when you look at this, we don't look on a trajectory back towards 2%, frankly.
No.
Why did the Bank of England cut rates? And why is the US talking about cutting rates? I mean, when we talk about the UK, the Monetary Policy Committee voted to cut rates on the back of deteriorating labour markets, leading to weaker wage inflation and lower inflation. And then we've seen from the Indeed numbers that we're having a weakening economy and strengthening wage growth. I think the MPC are just wrong. They should have kept rates higher and squeezed inflation out of the system.
Well, I guess they're trying to reduce government debt burden, aren't they?
It ain't working, mate.
I'm sure, there's a degree of arm twisting going on behind the scenes. It doesn't work, does it? I mean, there's a whole issue about whether central banks are useful or not anyway. So the Cleveland Fed median CPI, trim CPI, higher than it has been since the early 1990s.
Yes.
After COVID.
Yeah, and turned back up. So when you kind of look at the median item in the CPI basket, ain't coming down.
But do you remember when we had inflation is transitory and all that nonsense, and then it was coming down, and it was all out of the way, and people come out and say, "What if you look at historic inflation events? It doesn't ever just go up and down in one flush.
Yeah.
It sort of cycles up and down, and slowly the cycles get smaller.
Yeah.
So really, we shouldn't be in the least bit surprised that inflation is now going back up,
Yeah.
and that it will go up for a while, and it's going to oscillate, and gradually over the next few years drop back down. So
Yes.
it's sort of doing what historically you would expect it to do.
No, I totally agree with that, Richard. But well, something I got totally wrong. I was expecting inflation to come down quite quickly, but it ain't.
No.
So this is a really interesting observation by Robin Brooks. Is basically what he's saying is since COVID, the seasonal adjustment of the US CPI data has been off, leading to systematically lower inflation prints in the summer. So, bearing in mind that we're getting actually slightly higher inflation prints in July, when we'd expect lower ones, what he's saying is expect the seasonal adjustment to mean that inflation is going to be higher in the autumn and winter, and we have an inflation problem in the US.
So this is core services inflation, which is falling very slowly and is 3.6%. And we have core goods inflation rising quite significantly. Sticky inflation has risen very significantly from just above 2% to a bit below 3%.
I mean, you were talking earlier about waves, Richard.
Yeah,
that seems absolutely the same.
So low oil prices kept CPI from rising, core CPI from rising, but in other parts of the economy, inflation remains quite elevated. If you take the cutoff at around about all items at 2.7, and there's an awful lot that are over.
Yeah, absolutely.
Significantly over 3%.
Yeah. But so energy is not in core, it's in main. So
yeah. And super core, which doesn't include shelter, rose sharply in July. And if you take out real-time rental data, if you substitute real-time rental data into for owner's equivalent rent, inflation rates are low, but
yes,
beginning to rise again.
Yeah. In CPI, OER is lagging and is still coming down, basically, and will continue to come down for the next few months, which should keep a lid on inflation rises.
And variant perceptions inflation leading indicator suggests a further small rise in inflation, not runaway inflation. I mean, I'm not.
It's saying inflation is going to pick up. It's not below the chart. It's saying, but it's saying inflation is going to keep on rising, but the rise is not going to be terrible.
US PPI month on month, 0.9% in July, which is high, and 3.3% year on year.
Yeah, and that was a big miss. That was a big miss.
And the trend is upwards. Core PPI month on month, 0.9, and year on year, 3.7, again, upwards trend. So you can see why Powell doesn't want to lower interest rates, can't you?
Yeah, absolutely.
Finished goods PPI rose at 5% annualized rate in July. So a lot of the PPI miss was due to financial services, stock market related portfolio management, securities brokerages, dealing and investment advice, which are all a function of rising equity prices. So that means that if the stock market falls, then
yes, that's
PPI
right.
should also have a downward impetus.
Yes, no, that's exactly right.
And the direct impact of tariffs in the data was actually quite small at 0.4%. US retail sales are 0.5% in July and 4%, nearly 4% year on year. Industrial production was down 0.1% in July and up 1.4% year on year.
Yeah, actually, better than the last couple of years. Retail sales absolutely fine.
And Michigan consumer sentiment. It's hard to read anything into this chart at the moment. It's
Yeah, I
really
agree.
not what it's telling us. Current conditions, Michigan current conditions. Likewise, still to know what it's telling us. Michigan consumer expectations.
Yeah, just all slightly weakening.
Yeah. 1 year inflation expectations having spiked up really sharply early in the year, dropped back down sharply, and now looking to head back up a little bit.
Yeah, another reason why the Fed can't cut.
And 5-year inflation expectations basically looking like a very similar setup. And according to the Michigan survey, independents hate the Trump economy as much as the Democrats do.
Yeah, I thought this was really interesting. You see
Yeah.
huge difference between Republicans, what they think of the economy, and what Democrats do.
Yeah. US initial jobless claims, just looking at the chart, looks perfectly normal. Continuing jobless claims, staying a little bit high since the spring, but not moving higher at the moment.
Yeah, this is not a big change, actually. That's like 150,000 in the year.
Yeah, because the
Not
zero is
huge.
so high.
Yeah.
US job postings index for Indeed looks like it's actually moving, possibly a trend change there. We'll see.
Yeah. Well, tick up. Interesting.
And Indeed wage growth falling sharply, 2.4%.
Yeah. Yeah. Big contrast to the UK, 5.9% in the UK. And the Bank of England, UK base rates below those of the US. Shocking.
And LinkUp is still reporting rapidly declining job openings in the US.
Well, and to be fair, like the wage growth numbers would seem to support this.
Yeah.
Although the Indeed job postings index obviously has ticked up in the opposite direction.
And the Dallas Fed weekly economic GDP estimate, 2.5%. I mean, these charts are fairly flat, aren't they? At between 2 and 3%.
Yeah, the US economy is doing just fine, it would seem.
Atlanta now Fed 2.5%. New York Fed now casts 2%. St. Louis Fed actually minus 0.3%.
Yeah, that's the first estimate for Q3. Let's keep an eye on that.
And the economic surprise index basically seems to be fading away.
Yeah.
Trueflation in the US, 2%. And Americans now spend more on healthcare than on groceries or housing. How much is due to better technology? How much to inflation? How much to waste and bureaucracy? A lot due to the latter, I suspect. And it's very bad for poor people.
Yeah.
And the US health spend per capita much higher than anywhere else. And life expectancy is lower.
Absolutely.
So the life expectancy versus health spending in the US is pretty shit because they spend more and get less.
Yeah, exactly.
It suggests there's some inefficiency in the system, doesn't it, Keith?
Well, but also, this chart where this is like coverage. So you see, in most developed nations, you have 100% coverage.
Yeah.
In the US, you don't. And you'd suspect part of the reason they've got lower longevity is that people without health coverage don't do very well. I mean, some of these other countries with low healthcare coverage, I mean, I was astonished. Cyprus, 65%.
Yes, that is unusual, isn't it? One considers Cyprus to be a developed European country.
Oh, exactly. India, it's like less than only about 10% have health insurance or health coverage.
So US graduate jobs, it's a tough labour market, and it looks like that might be in recession.
Yeah, certainly tough labour market for new grads.
And the jaws of stagflation, employment versus prices paid in the US, as it says here, wide open. So there's the summary. bottom line, the US economy is still doing fine. The labour market is definitely slowing. And also their inflation does not look like it is still falling.
Yeah, it's certainly going to pick up in the next few months. How high it's going to get, we don't know.
Yeah.
On to China. So house price growth remains negative, but not as negative as expected. Industrial production disappointed, falling to 5.7% year on year in July. Retail sales also disappointed, falling to 3.7% in July. Fixed asset investment disappointed to 1.6% year on year in July. That's not good. Yuan loan growth in July was the first actual negative data point on this chart going back 10 years. Money supply was growing actually 8.8%. Outstanding loan growth continues to fall to 6.9%, again disappointing. Producer price inflation remains negative at minus 3.6%, and that's worse than expected. Thought this was interesting. We don't really trust official data, but when you look at cement use, that shows that the long Chinese construction boom is well and truly over and has now been falling for, what's that, 2014, for actually 10 years, 10 years and still falling. So actually all the Chinese data was weak. Heading towards stagnation, question mark. And onto one chart. Now, this is the percentage of US businesses that have absorbed tariff costs. So as of June, I know we're now in August, but as of June, 64% of US businesses had essentially absorbed the costs. Medium term, Goldman Sachs is expecting only 8% of US businesses to absorb tariff costs. Therefore, slowly over the coming months, and we're now in August, those businesses are going to start raising prices and passing on tariffs. And that will be bad for goods inflation. And when you look at the effect of tariffs on goods inflation in the US, you see it has already had an effect. Although the absolute rise may not be huge, deviation from trend is really quite significant. Up 5% for imported goods and up 3% for domestic goods, which will contain imported components. I know we have at least one female viewer, Simon, who had asked me to have a look at junior Sipps, junior ISAs, and lifetime ISAs. So apologies for delay, but we're doing it now. Now, I have talked previously about how we use the junior SIP and give our children the maximum every month because you get an extra, the government tops it up by 25%. So if you put in £100, they actually receive 125. But we've also looked at the other tax efficient savings schemes available, and Richard will now go through them.
Thank you, Keith. So the junior self-invested personal pension, aka SIP, is open to anyone under the age of 18 and has to be opened by a parent or legal guardian on behalf of the under 18-year-old. Maximum annual contribution is £2,880, which is £240 a month, and it attracts tax relief at 20%. So basically, in order to get that, assuming your junior isn't a taxpayer, the government will top up any contribution by 25%, which clearly is significant uplift and can take your potential total investment, gross investment in the SIP to £3,600 per year. But you can only access the funds on retirement at the age of 55 or over, which goes up to 57 in 2028 and will probably be raised further in the future because that's the trend with pension investments in this country. So they can be invested in a wide range of securities, presumably the same range that that the full SIP can be invested in, which is equities, bonds, ETFs, and property. And investment returns within the SIP are untaxed until they are withdrawn and spent on retirement. And that clearly is very advantageous. So, put a Hargreaves Lansdown, if you take full advantage of the available relief and you pay in your full monthly allowance, including tax relief of £300 a month, till your child is 18, from the age of 1 month, pension will be worth £581,000 when they are 65, given a return of 5% per annum.
Yeah. Now, obviously, that's nominal.
Yes. So obviously, the actual value of that pension in terms of providing you with a living depends on what the rate of inflation has been over those 65 years.
Yeah. But, I mean, what prompts all this is a few months ago, we showed a chart of returns if you start investing at age 18, and in turns if you start investing at age 30. And the difference is absolutely huge. Time value is really important. Yeah. So if you set your kids off with some pension money early in their lives, the power of compounding is absolutely enormous. And essentially, you can pretty much give them all the pension they need by just giving them, 2,880 quid of your money every year for the first 18 years of their life. And then, they can top it up a bit, but, they're well set.
Indeed. Yeah. It's a pretty good deal, really. So our conclusion is it's a no-brainer. That's the technical term.
Yeah.
Great way of transferring wealth between the generations whilst saving tax. Rachel Reeves, don't look at this.
Yes.
And you can continue to pay into the SIP even if the children are over 18.
Yeah, it's now a SIP rather than a junior SIP, but we continue to pay in on their behalf. And regular payments are not included as gifts and are tax exempt. So that is something we're just going to keep on doing, frankly.
So the junior ISA, individual savings account, 2 types of ISA account, a cash and a stock and shares. The maximum that can be paid into the ISA in the tax year 2025-26, £9,000. And you can split it any way you like between cash and stocks and shares, ranging from 100% in either. Mm. No tax relief, but there's no tax paid on assets, gains, capital gains, or income within the account. And the child gains access to the account at the age of 18. Children generally don't pay tax on interest in their savings because they're below the tax. Because children have a tax-free allowance, the same as everybody else, I believe. Yeah. But of course, if there are significant capital gains in the ISA, then they won't pay capital gains tax either.
That's true. Yeah, HMRC generally don't come after children. So, there's unless they're going to build up quite a large stocks and shares portfolio, then there seems little benefit for having a junior ISA compared to just a savings account.
I think the idea would be that you should build up a stocks and shares portfolio.
Yeah.
With capital gains.
Yeah. But you get no tax relief, it's just that you transfer the money to them. And then, at age 18, they get it all. So.
And you can't stop them from getting it.
No.
And then there's the LISA, the Lifetime Individual Savings Account. So designed to support 2 key events: purchasing a first home or saving for retirement. Launched in 2017, open to people between the ages of 18 and 40. Maximum contribution currently £4,000 per annum, 25-26. And once you own a LISA, you can continue contributing to it until the age of 50. You get tax relief of 20%, very similar to the junior SIP. The government topping up each contribution by 25%. So therefore, your maximum gross annual investment becomes £5,000. The maximum bonus if you add 4,000 a year between each year between 18 and 50, then it becomes £33,000. Top up takes a little while to arrive. And there are two different types of account, the cash and the investment. So what can you do with a LISA? So you can use it to purchase a new home up to the value of £450,000. It's actually not a brand new home, it's just a new home for you.
Yeah.
Or to pay retirement from the age of 60. And if you withdraw the money for any other purpose, effectively, you lose the tax relief.
It's worse than that, actually.
Because you lose 25%.
Yeah. You actually end up losing 6.25%.
Right. So you don't want to, we do really want to be, to use it for the designated purposes. So also if your child has a LISA and you contribute to it on their behalf for 20 years, they'll have a significant lump sum to put towards buying their first home.
Yeah.
But the purchase price, to get the relief, the purchase price of the home has to be below £450,000. So that cuts out certain high price areas such as London. If you use the money to buy a house with a value of more than 450,000, you lose you incur the penalty, as Keith said, net loss of 6.25%. And as a retirement savings scheme, it's inferior to a pension, but of course, it's in addition. You can make it in addition to the junior Sipp.
Yeah.
So it's inferior because you don't get the same tax reliefs that you get in your pension. And you can't take it out at the age of 55 if it's a LISA. But you incur no tax on withdrawals from a LISA as a pension, whereas withdrawals from a pension are taxed at your marginal rate once you've taken out your 20% cash lump sum. So if you have available cash to do these things for your children, they are in fact all quite well worthwhile, and they're all long-term investments. And long-term investing is over multiple decades is a very good way of accumulating wealth.
Well, the thing is, Richard, what we've done is we do the child Sipp every month. So that's £2,880 per child and that government tops that up to 3,006, and we're going to keep that going. We haven't done either of the other two.
Yeah.
And the LISA, I think, only works if you are outside London. So if you can buy a starter home for less than 450, because otherwise basically the money is going to be trapped in the account until they have a pension. And if you've done the child Sipp, they're not going to need a second pension, frankly. Yeah. And the reality is you want to give them the money while it's useful to them, not when they're 60.
I mean, the best use of the LISA is definitely towards buying their house.
Yeah. So I have a nephew who is looking to buy a home in Bristol, and he's got one of these and putting in his own money, and he needs to save up 30k to get a deposit on a house. Brilliant. Works really well. You get an extra 25% on anything you put in. And, if you live outside London, I mean, I think the scheme works quite well for, young people. But in London, it don't. I'm afraid. Okay. Thank you, Richard. And on to ChatGPT-5. How good is it? Well, so in benchmark coding test of real world Python coding task, GPT-5 did better than the competition, but look at the intensity. Yeah, it's working really hard, to produce good output. So your cost is rising quite quickly to get good outcomes, but it can do much better than OpenAI o3. In the maths competition, this is competition level maths with and without tools. Now, what's a tool? A tool is a special subject-specific adjunct to an AI model. So with thinking, i.e. going in depth, these are good results. But OpenAI also did really well. So the incremental increase is quite marginal. In a software programming exercise, GPT-5 with thinking, i.e. going in depth, again, does better than OpenAI. But again, it's an incremental improvement. It's not enormous, and it needs to do thinking in depth to have any improvement. And that is expensive. Competition looks at how AI does at searching the web and doing user-specific tasks. Results not great, actually. Not really much better than OpenAI 03. So question, on all these charts, the x-axis has tokens. What are tokens? Well, input and output tokens refer to the units of text the model processes and generates. So these tokens are the building blocks that allow the model to interpret and generate language. So the more tokens, the more complex the question and answer. So input tokens are the piece of text you provide to the model as input. So that's a question, a sentence, or prompt, or whatever. And the language model then breaks that down into smaller units. And those smaller units are called tokens. And they can be individual characters, words, or subwords. So, for example, the sentence, hello, how are you, might be broken down into several tokens. Hello, the comma, how are you, and the question mark. And the model then uses those tokens to understand the meaning and context of your input. So the aim of tokenization is to split the text into the most efficient and meaningful pieces of information that the model can use. Now, the output tokens are the piece of text the model generates as a response to the input. After processing the input tokens, the model predicts the next most likely tokens to produce a coherent and contextually relevant output. And so the model generates the tokens one at a time, predicting the next token based on the previous one until it reaches a predefined limit. So, for example, if the input is what is the capital of France, the model might generate the output, the capital of France is Paris. Each word or punctuation mark in that output is a token. So when you put in a short question to ChatGPT and it comes out with, many paragraphs of explanation and answer, those are all tokens. So large language models like GPT have a token limit, which refers to the maximum number of tokens they can handle in a single input-output interaction. That limit includes both the input and output tokens. So if a model has a limit of 4,096, that means the total number of tokens in the input and output must not exceed that number. If the input is too long, the model will simply truncate it. Good news, the hallucination rate is much lower. I mean, frankly, I thought the hallucination rate on OpenAI 03 was just totally unacceptable. 5.7%, 5%. Renders it largely unusable, I would have thought. But notice they only provide data for the thinking version, so which takes longer, uses much more computational power. So question, what's the difference between ChatGPT and ChatGPT-5 with thinking? Well, what ChatGPT does is it actually consists of several models, and it will take a first pass at your question, decide how much thinking it needs to do. If it decides to think, it will go in depth and take some time, apparently up to like 10 minutes, quarter of an hour to produce an answer. Whereas if it thinks it can just produce an answer very quickly, like what's the capital of Paris, it'll just use a light model and churn that out quite quickly. Now, On humanity's last exam, with thinking, it scores 42%. Without thinking, well, so the basic model with no tools scores 24.8%. In contrast, OpenAI scored 24%. So an increase, particularly when you do with thinking. Now, what is humanity's last exam? Well, it's a benchmark of 2,500 hand-created PhD level questions spanning maths, physics, chemistry, linguistics, and engineering. With and without tools, there's a big difference. So what's a tool? Tool is a specific software application that uses artificial intelligence algorithms to perform specific tasks and programs, i.e., it's been developed particularly for a field. And let's look at humanity's last exam. And these are tough questions that you are feeding into the model. Yeah. So here's a representation of a Roman inscription found on a tombstone. Provide a translation for the Palmyrene script. So the AI has to recognize the text and then translate it from Roman into Palmyrene, which is a city in the Roman Empire, now in Syria. So these are not easy. Pause, have a read of this. This is from Ecology. These are not simple questions. Maths, really PhD level questions. Chemistry, the same. So, so AI models are working at a really high level, although the absolute accuracy of their scores is not great. 25% for Grok. And when you look at, how ChatGPT 5 does compared to all the others, Grok 4 is the best. It is better, but these are marginal improvements. It's not a leap. And researchers have questioned the accuracy of OpenAI's self-reported tests. So Princeton University have their own tests. So the core bench test looks at the ability to AI to reproduce published scientific papers. So they're only given the data in the paper, and they've got to basically reproduce the paper using just the data. And I thought these were really interesting. Look at this. So on the core bench test, by far the best is Claude Opus 4.1, although it uses a lot of computational power. ChatGPT 5 is nowhere near as good, although it is on the kind of cost, it's on the cost accuracy frontier. So it's relatively cheap for the results you get, but in absolute terms, not great. So the Gaia benchmark test looks at, it's got basically it's a set of questions in which there is an unambiguous answer. 165 questions. How does GPT-5 do? Answer. Again, not great. It is close to the top, but not very efficient. And frankly, not the top. Not the top is over here. You'll notice, look at how cheap some of these models are. Is that DeepSeek is not the most accurate, but it's very cheap. The SWE Bench Verified test evaluates its software engineering tasks using AI to solve real-world bugs, like software bugs. Again, ChatGPT 5, not the best. It is relatively cheap, but, again, Claude, substantially higher. But GPT-5 is relatively cheap. So you're seeing Claude Opus 1, $75 per output token. ChatGPT 5 is 10, but then DeepSeek is $2.19. DeepSeek V3, $1.01. And it costs one hell of a lot to develop. Now, I'm not sure how accurate this is. This originally comes from a HSBC piece, but they're saying ChatGPT 5 costs between 1.7 and 255 billion to develop. There's no doubt that the productivity gains from AI are enormous. The question really is whether the continued investment, enormous investment in AI, is yielding worthwhile incremental gains given the cost. Currently, only around 9% of companies in the US are using AI. There's, AI could is likely to transform the economy, but it's going to take a long time. And are we already seeing the effect of AI in job placements, job postings? So job postings for data analytics and software development are down 40% since pre-pandemic. So, Richard, what are your thoughts? We've gone through it in quite some depth. ChatGPT, it doesn't seem to be the most powerful. Its competitiveness really is on the pricing model. And, it's cost billions to develop. What does that tell us about the whole field of AI? Your thoughts?
It's obviously, it can be very clever, but it's like you take the human intelligence questionnaire, whatever its technical title was, Keith.
Yeah.
Those questions are very complicated, but basically what it has to do, it has to go away and look it up in information that's straight from the internet.
Yeah.
It's not actually intelligent. It's jolly good at putting together an analysis, a coherent analysis of a great deal of information that has already been. It's just that it has come across all very clever, interpretation of scientific symbols and so forth. It recently has generated 2 new antibiotics. Obviously, they need to be clinically tested. That's extremely powerful. So I think it has extremely powerful use cases. I think that as a generality, it's not. I don't think it can change the world as we are now. I think that is several generations away, and I'm not sure that that's an iterative generation. I think maybe there needs to be some sort of step change in the way it thinks and works, and in fact, the cost of doing it. So I think there's several technological steps that haven't yet been identified that will take it much further than it is now. I may be completely wrong.
I'm looking at those charts, Richard. A few months ago, we showed this chart of the increase in capability of AI versus its cost/complexity. And basically, you were getting small incremental improvements in capability at vast, large increases in its cost. And actually, I think ChatGPT 5 shows that in action. It's cost a hell of a lot to develop. And really, you've got quite marginal increases in capability, which leads you to think that actually there is a limit to where large language models are going to get us, and they're not going to get us to artificial general intelligence. Because, as you say, basically, they don't really understand what they're doing. They're just working on correlations.
Yeah, I think that's right. So I think, yes, there's some extremely powerful use cases. A lot of it is curiosity, and me getting it to write an essay on something for free is not a sustainable business model. And given the amount of capital that's been sunk into it, I suspect there will be 1 or 2 successes and a lot of failures. And I do think that over the next 5 years, probably, there will be a massive shakeout.
Yeah.
Who's going to get shaken out and how and why, as it were, very difficult to say. And I think the route, the route for the existing models is agents, business agents, and I think that they can be very powerful. They are confined. The parameters are very clearly set. The training data is very clear. They could be easily their output could be easily monitored by someone who's an expert in whatever that the field is. So yeah, I think so. There are some powerful use cases, and then there are some use cases that really don't work.
So now we're going to talk about the investment disaster that is Brewdog. Now, I found this salutary and really interesting. So, reminder, Brewdog is a Scottish craft brewing company that funded its early growth through direct share sales to punk, quotation marks, private investors. So this is from a fundraising document, Equity for Punks. Its pitch document for, trying to sell its shares to its customers, private investors. And you'll note that it had an enterprise value of £1 billion then. So it was not selling its company cheap. By 2017, it had raised 41 million from 50,000 private investors. And its pitch was, it was appealing to independents, punks, etc., who I would consider to be the financially naive, saying that, Brewdog was going to take on the system and they were going to benefit. But difficult to take on the system and make a decent return when you're valuing the company at £1 billion. So here you go. Note the pitch line at the bottom. Here's the crazy ones, the misfits, the rebels, the ones who see things differently, because the people who are crazy enough to think they can change the world are the ones to do so. Nowhere in the 27 pitch doc was the valuation mentioned. So in 2017, having raised 41 million from private investors, they then did a fundraising with private equity. Now, this is a real cautionary tale. So it sold 22.3% of the company to US private equity company TSG Consumer Partners in a deal that valued the company at £1 billion. The founding partners shared 100 million. And so they then claim to have delivered absolutely fantastic returns to their early investors. But only 13 million of that 200 million deal was available to allow small investors to cash out. They could sell a maximum of 15% of their stake, or 40 shares, whichever was the bigger, whichever was the smaller. And that was what? £1,000. So the maximum you could take out was £1,000. So you couldn't exit at all. And you would think that having raised, 200 million, that they would now stop raising from private investors, but actually they didn't. They started raising even more. They raised 23 million before the private equity deal. They raised 67 million in the 4 years after, all from private investors, the punks. And what's really interesting, and this is from a 2020 subscription doc, is once again, in the whole pitch doc, there's no mention of the valuation. You have to dig through the 60 odd pages of fine print to find the numbers you need, i.e. the share price and the numbers of shares in issues. And that comes out to an astonishing 1.85 billion. So they're selling these shares to the public at a really aggressive valuation. Now, let's put that in perspective. Using the EBITDA from the 2020 annual report, Brewdog was selling its shares to its customers at an enterprise to EV/EBITDA ratio of 259 times. The average is what, 15? Craft beer company might get to 30. That's an astonishing number. So essentially, it was ripping off its customers in this share issue. And the 2020 annual report also reveals a loss for that year of 13.2 million. So the last funding round in 2021 raised 30 million from private investors at a price of 25.15 and a valuation of 1.85 billion. Previous year, they'd lost money. But you also got a few freebies, a free beer on your birthday. Invest in at a valuation of 1.85 billion, but you get free beer. So summary so far, Brewdog has sold shares at very high valuations to private investors. In April 2017, it then sold a 22.3% stake in the company to a US private equity firm at a valuation of $1 billion. The founders pocketed 100 million. Now, to understand what happens next, you need to understand the capital structure. And I know we have a few students watching the podcast, so the basics of the capital structure. So the capital structure refers to the mixture of equity, preferred equity, and debt that is used to finance the company. And what is really important is the seniority, the order of priority. So if the company goes bust or is taken over or gets into trouble, whatever, and its assets are liquidated, who gets paid first? Well, they get paid in order of senior debt, subordinated debt, preference shares, common shares. So if there's not enough money to go round, the senior debt holders, they're the lowest risk, they get paid first, followed by subordinated, and essentially common equity get whatever's left over after everyone else has been paid. So let's go back to the 2017 PE deal. So TSG Consumer Partners invested 213 million, but they didn't do it in the common shares. What they did was, first of all, they amended the company bylaws to remove the right of existing investors to participate in any fundraising, which is the preemption rights. The founders then converted some of their shares into preference shares, which they sold to TSG for 110 million. Brewdog also issued 103 million of new preference shares, which they also sold to TSG for a total of 213 million. And based on the share price, that valued the company at $1 billion. Now, what are preference shares? So preference shares are similar to common shares, i.e. they're a share in the profits of the business, but they have a fixed dividend and more limited voting rights. What they have in common with shares is the company can miss the dividend, and that is not a liquidation event, essentially. So if you hold debt, if the company issues debt and misses an interest payment, that is an insolvency event. If you miss a preference dividend, it is not an insolvency event. So what was the dividend on the preference share? It was 18% compounding. So since 2017, the value of those preference shares issued to Brewdog has been steadily rising at a compounding rate of 18%. In 2025, the value exceeded 800 million. Now, remember the capital structure and the seniority. That debt of 800 million is senior to the common shareholders. So right now, Brewdog also has debt of 227 million as of the financial year 2023. So the total enterprise value of the company, if you include the debts to the preference shareholders plus the actual debt, is $1 billion plus. In order for the common shareholders to get anything out of this, Brewdog would need to be sold for well over $1 billion. If the sale is delayed until 2026, the value of the preference shares rises to 945 million, then in 2027, 1.12 billion. How is the company doing? Well, from Companies House, 2023 results, the company reported a loss of 64 million. In 2022, reported a loss of 25 million. Who is going to pay over £1 billion for this company? And when you look at its assets and liability, its balance sheet, the company had net assets of only 94 million at the end of 2023, having raised 213 million from TSG, 93 million from private investors, i.e., over the last 15 years since it's founded, it's lost at least 212 million pounds. And note the debt of 226 million. So you can't, there is an exchange whereby you can try and sell, unlisted shares called Asset Match, and there are very few auctions of Brewdog shares. But you can see the last one in 2022 was well down from the previous high. Now, there have been stock splits, etc., which make it difficult to relate the price here to the 25.15p price that shares were issued to the public at. But the bottom line is Brewdog has almost certainly lost all those small investors, the punks, all their money. Having raised 93 million from small investors, primarily in the UK, all that money, if there is any, is going to go to the US private equity company, TSD Consumer Partners. The only positive is that because TSG only own 22.3% of the company, they can't force a sale. And so the small shareholders can basically say, we're not going to sell the company unless we get something out of it, which gives them a little bit of leverage, but that's it. So investment lessons. I mean, investing off exchange in startups is really difficult, as Richard and I know. In order to do any off exchange unlisted investment, I think you need to expect at least a 5 times return because the risks are so against you. So when Brewdog was selling shares at 1.85 billion valuation, unless you could see Brewdog getting to a valuation of 9 billion, you shouldn't have done that. So the investment case was incredibly poor, and Brewdog knew it because they put they never mentioned the valuation at all in the pitch docs. And beware of messianic CEOs. Do they have your best interests at heart? Are they financially naive or are they cynical? He's walked away with 50 million. All the small investors who believed in him, they're wiped out. If you invest in unlisted securities, you are trapped. There's no exit. You might be able to find some liquidity on Asset Match, but reality is it traded 4 times in 15 years. Emotional investments are rarely wise ones. Richard, your thoughts?
So you and I have done some angel investing, Keith, haven't we? And it is extremely difficult, I would say. Much harder than I thought it was going to be. Harder. It's not difficult to invest. It's difficult to invest in companies that are going to be successful.
Yes.
And then when you do find a company that's going to be successful, and you are lucky enough to have done that, there are a lot of pitfalls along the way, including what effectively here is a very large dilution of your interest. And for whatever, this is a special case of the original investors being totally diluted, so that their initial investment hasn't appreciated in line with the value of the business, whatever you think of the valuation of the business. And that's a common problem as well. So I do think that you do have to be really careful with angel investing, and you have to really understand what the risks are. And it's very difficult. And this is I think this is a fair, I think quite a lot of the big US companies, now large US companies, I think a number of those had small investors who really didn't make much money because of the dilution that they experienced. As I say, this is almost just another example, really, of that sort of process whereby the financially sophisticated.
I mean, I would say, Richard, that it's not really dilution in this case, in that because their shares, dilution implies you're getting a smaller and smaller share of the pot, whereas in this case they're not getting anything of the pot because somebody senior to them in the debt ranking is getting everything.
And then obviously with the preemption rights for change, that's because as a small investor you don't have, or even as a group of small investors, you often don't have the sufficient interest combined to stop the articles of association of the company being changed.
Yes, exactly.
Which is another risk. So yeah, I mean, it is a difficult thing to do. It's very easy to lose all your money, and I would say it's pretty difficult to make a decent return on it. People do, but it's pretty difficult.
Yeah, I'd agree with that. Richard and I started angel investing in 2016. We have yet to have a winner 9 years later. And on a related subject, pump and dump scams. Richard.
Thank you, Keith. So what is a pump and dump scheme? This relates to listed shares and small investors usually. So the people who are planning on conducting the scam will buy a large position in a small and illiquid stock. And they may well do that quite slowly, I guess, so that they don't move the price that much. And then until they've got the holding they want. And then basically they use various methods of publicity to boost the price of a stock, and often with exaggerated claims, misleading exaggerated claims, social media. In the old days, it used to be newspaper articles, less so these days. And you probably get, I know I get various spam emails from people saying this company is going to be worth a fortune, or this is a fortune, or X is invested in this and Y is invested in that. And so the share price starts to rise, and everybody there's hype. Everybody rushes in to buy the stock, and the stock price goes up very, very substantially. And then the scammers will sell their stock as quickly as they can, making a tidy profit and leaving the small investors holding shares that are effectively worth as much as they were before the pump and dump scam began, which is as like as not very little. And last week, small investors in the US lost billions when the share price of 7 small Chinese companies listed on the NASDAQ saw their share prices collapse by more than 90% a day after they had been heavily promoted on social media. Social media goes viral and everybody leaps in hoping to make a quick profit and profit for everybody else. And then the promoters sell very quickly. And there's not much I don't think there's so much that the regulators can do about it either, because it's totally dependent on people actually understanding what it is that's going on, and that's
Yeah.
a lot of investors, small investors, can be quite naive.
So this is one of the companies that collapsed last week. It was a small company called Austin Technology, and this is the share price during the pump phase. Now, so its shares shot up from what, $1 to the best part of $10 on this chart. Now notice the big spike in buying just before this trend gets going. Okay, so no volume whatsoever. Scammers buy in and then they start to pump. So this is how the Austin Technology scam worked. So investors were added to private WhatsApp and Telegram groups with names like Premium US Equity Picks, etc. Frankly, on our Discord, we are constantly trying to fight these people as they try and get on. And then they use lots, they create lots of false identities. They create then artificial conversations between these identities saying how they're invested, how they're buying more. It's going to go up every day. It is going up every day because they are buying and pushing the shares up. But behind the scenes, Austin Technology, on 15th of April, they offered 9 million shares with warrants, creating 91 million additional shares, i.e., they are going to dilute shareholders by an enormous 1,200%. So it was the company in on this as well? Question mark. On the left here is a screenshot of one of these Telegram groups or something. So in the pump phase between mid-April and June 26, Austin Technology shares rose from 46 cents to $9, a rise of over 1,000%. Then in the dump phase on the 26th, the shares fell 95% in a day and has since fallen to 99% from their highs. This was never a strong company, and falling revenue, negative operating income, negative cash flow. A cursory look at the numbers would have revealed the underlying company looked like a poor investment. And as always, it's the poor and the gullible who lose their life savings. On the left is a WhatsApp chat from people who were invested in the company. Pause, have a read. I lost 21k today, etc. People go in, get sucked in, and invest their life savings. This is Austin Technology going to zero. The scammers buy in, pump it up, they get out, kaboom. Concord International Group, same story. Top King win. It's quite a small pump and dump, but similar outcome. Now, all this is quite a short time scale. These are from February to August. Yeah. There are a few of them.
Yeah, thank you, Keith. So the bottom line is you have to be really wary of any share tips you see on social media. You have to question why anyone would tip a share on social media anyway.
Yes, good point.
You know, what is their motivation for doing so? I certainly never would. Always do your own research. Don't just believe the share tipper. Never invest more than you can afford to lose. And if it looks too good to be true, then it probably is too good to be true. And just be very, very wary and get corroborating information and so forth from other sources before you invest like that.
Yeah. Okay. Quiz of the week. Richard, you ready for this?
I'm ready, Keith.
Good. Because, okay. So H&M have introduced digital twins of their models. Which one of these is the real Matilda?
The real Matilda?
Yep.
Oh, right. Is there some clue?
Nope. This is a really hard task. You staring at these two lovelies for,
Oh no, give me half an hour, Keith. Well, maybe if you could see them moving, but without seeing them moving, I'd say the one on the left is, but that's probably wrong.
The real Matilda is the one on the left. Well done.
Oh, why did I say that?
Then no. Go on. Why did you say that?
Why did I say that? Something to do with the shape of the face?
Okay. I'd say the fake is astonishingly good. I wouldn't be able to tell.
Yeah.
Okay. Which one's the real one?
All right. The one on the right.
How do you know that?
The one on the left is just perfect. The one on the right is not perfect.
Okay. Good. Okay. What about this one?
Gosh, it's really tricky, isn't it? I want to get 3 out of 3 here. What's my prize, by the way, Keith?
Not investing in advertising companies. That's your prize.
I think the one on the right again.
No. You're blaming it. As I was thinking, actually, your diagnosis, the problem of, the real one's always slightly imperfect, would lead you to the one on the left here, because the one on the right does look perfect.
Yeah, that's why I chose it, because you should know.
Yeah. Anyway, so bottom line is, I think AI is going to really take a hammer to the advertising industry.
Yeah.
So a few weeks ago, I was running on Hampstead Heath, and I accidentally ran into a film crew who were filming, down by the ponds. And the first I knew about it was I was surrounded by tents.
Right.
And there were just, there must have been 50 people. There were 2 actors and there were 50 people.
Yeah.
Catering, makeup, etc., etc.
Yeah.
And, if you can just produce,
very labor intensive business, isn't it? And that's all for probably 10 minutes max of
yeah, exactly. So I think all of that is in big trouble.
Actually.
Yeah. So looking through the share prices of some advertising agencies, WPP down 2/3 since 2022. Publicis actually not done too badly, but down 20% over the last 18 months when the rest of the equity market's been flying. US advertising group Omnicom down 25% from their peak last year when, again, US shares have been doing very well. IPG down 35%. So advertising companies not doing terribly well. And frankly, I think it's going to be tough. Okay, second quiz of the week, Richard. You ready?
Okay.
Right. ChatGPT has 1.5 billion users. What percentage of them are paid subscribers? So
let me just check, Keith.
It's going to tell you an enormous number. So personal users is $20 a month.
Right.
Business users $200 a month. And this is a transformative technology, Richard.
I'd say 2% of personal users and 5% of business users.
Actually, we don't have that number, but ChatGPT reports 0.9%, 6% of users are paying subscribers. Independent sources actually bizarrely have it higher. They have it about 2.6%. In either case, not enormous. So
and not enough to make it.
Yeah.
Yeah,
basically, this is meant to be a transformative technology. Everyone's going to cough up loads of money. No. So
I actually think that for me, the most useful application of AI is on Google searches, where you get that little summary, and then you can expand it and read a bit more, and that's quite interesting. But very rarely do I want much more information than that. And often what I'm really looking for is something, a more detailed description on a specific website, and it finds that as well. So it's like, why would I pay for that? Because they use my personal data, which I resent. But why would I want to pay $20 a month for it?
Yeah, absolutely. So there are all these vast amounts of money, as you can tell. This segment we did earlier on GPT-5 cost vast amounts to develop a new model, and you're in a constant race. So GPT-5 comes out, they're going to have to work on the next one because their competitors are launching theirs. I just don't see how it works. I just can't see how they'll make any money. And finally, last segment. You like this, Richard?
Right. So alchemy and gold. Basically, you don't need to dig gold out of the ground anymore. You can make the stuff in a fusion reactor. American fusion startups propose using the neutrons produced during the reaction that creates energy from combining hydrogen nuclei to form helium nuclei, which is what goes on in the sun, to turn mercury into gold, elemental mercury into elemental gold. So Mercury 197, which is an isotope of mercury, Mercury 197 is unstable and decays into gold with a half-life of 6-7 hours. So what you do is you use high-energy neutrons to produce. So you use the high-energy neutrons produced in the fusion reactor to convert Mercury 198 into Mercury 197 by knocking a neutron out of its nucleus. And if the Mercury 198 is put into the blanket surrounding the reactor core, it would absorb the high energy neutrons from the core and be slowly converted to gold via the Mercury 197 process. So you take your fusion reactor and it turns into effectively a gold producing reactor. Yeah. And Marathon Energy forecasts that fusion reactors could eventually produce around 50 tons of gold a year. And gold 197 is the only stable isotope of gold, but the fusion process would likely produce some unstable isotopes as well, meaning the gold would need to be stored for a period of time, suggested here to be 16 years, before it ceased being radioactive. I mean, yes, I think as a conclusion, alchemy is theoretically possible. And in fact, it occurs in supernova.
Yeah.
But fusion has always been 10 years away. And I think it's still 10 years away, isn't it? It's been 10 years away for 50 years.
Yeah. Well, I totally agree with you, Richard. I mean, I'd love it to be here, but, you know.
It is fascinating that I think it's every element over the atomic mass of iron has been created in a supernova.
Yeah.
Or I think iron as well, actually. So isn't that extraordinary? We are stardust.
Yeah, but iron is the bottom of the energetic table, isn't it? It's the most stable element. Hence, there's so much of it. Quickly on to other charts. Thank you, Richard. And these are all about property in the US. So commercial property not doing so well. Chart on the left, commercial property prices down 17% from their peak, going nowhere. Return to domestic properties. Well, you know, we've talked about this relentlessly over the last couple of years, that, you know, new single family homes for sale continue to rise and are very high by historic standards. So why is the industry still building them at a pace when affordability is really stretched? So the blue line is the medium income. The yellow orange line is the income you need to qualify for a mortgage from Fannie Mae and Freddie Mac. So loads of people are just priced out of the market. The house price is still rising, according to Case-Shiller, but only at 2% per annum. Meanwhile, rental vacancies continue to rise, which means rental inflation in the US is actually negative. So that should be good for CPI if that becomes reflected in OER. And finally, on to good news. So last week we were talking about, you know, building houses from soil. Well, the University of Maine has used the world's largest 3D printer to build a 600 square foot wooden cabin using sawdust from the state's lumber industry. So again, 3D printing buildings. So each module is 100% additively manufactured, including the roof, which differentiates it from, you know, the house we saw last week, where they're just 3D printing the walls, and all the materials are 100% recyclable because it's made from wood. A few pictures.
It's rather nice, actually, isn't it?
Yeah, very 1970s.
Yeah.
Curved walls.
Did they make the furniture as well?
No, you can see the doors are made something else, but you can see this grain
Yeah.
indicative of 3D printing. It's been layered down.
Yeah.
So
Very clever.
yeah, coming your way perhaps.
Yeah.
And concluding comments. Well, um, there's no sign of a ceasefire, although in the Ukraine, although Trump would like one. Let's see what happens. The big news in the week was that UK bond yields continue to rise, and the 30-year has hit a new high. The next weekly will be in a couple of weeks, and one of my Discord members, Muscle Riot, has sent me some stuff on why UK yields will not come down when inflation comes down because of heightened credit risk, and we will talk about that next time. UK inflation numbers out tomorrow. Be afraid, be very afraid. I mean, the number I really didn't like this week was the Indeed UK wage inflation number. Wage inflation heading back up. That's a terrible number.
Yeah.
In the meantime, thank you very much for watching, and it's goodbye from Richard Wheater.
And it's goodbye for Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.